I'm Al Brooks. I want to thank you very much for watching this video. This is the second of two videos on small patterns, II, IOI, and OO. And in this video, I'm going to give some examples. I'll begin by talking about II patterns, consecutive inside bars. An inside bar has a high at or below the high of the prior bar, and a low at or above the low of the prior bar. And if you have two of them in a row, you have inside. You have an II pattern. An IOI pattern is an inside bar following an outside bar. An outside bar has a high at or above the high of the prior bar, and a low at or above the low of the prior bar. And therefore, the bar before the outside bar is inside of the outside bar. If you have an inside bar following an outside bar, the bar before is inside, so you have inside, IOI. And finally, I'll talk about OO patterns, consecutive outside bars. Here are some examples of II patterns. We have a strong rally here, and then we have an inside bar and a second inside bar. It does not matter that the lows are exactly the same and the highs are exactly the same. Remember, an inside bar has a high at or below the high of the prior bar, and a low at or above the low of the prior bar. So this bar is inside of that, and this bar is inside of that. It's coming at the end of a biclimax, and biclimaxes sometimes end with II patterns or OOs or IOIs, but of those three, most often, if you're going to get a reversal in a biclimax, it'll be from an II. If you're looking to sell, you want the second bar to be a bear bar, and you prefer it to close near the low of the bar, at least in the lower third. If you're long, you get out below that bear bar. And if you're willing to take the swing down, it's a reasonable sell below the low of that bar. From the first video, I talked about how the math is good for these patterns. If you sell below the low of the bar, you put your stop above the top of the II or the top of the trend, and your risk is not very big, and your reward can be very large. So you have an excellent risk-reward ratio. And the probability of these patterns is about 50, sometimes 60%. So let's say it's 50% chance that you'll get a swing down, and the reward potential can be many times greater than the risk. And therefore, a pattern like this has a very good trader's equation. It's a very good trade. Some traders will enter below the low of the bar. Some will wait for 2 or 3 bear bars and then start to short. Once you have consecutive big bear bars breaking out, it's high probability that we're going lower, maybe a measured move down. By breaking out, I mean a close below the low of the prior bar. This is a breakout bar as well. It closed below the low of that bar. But this is an exceptionally big bar, closing far below support. The bulls wanted a double bottom with this low and that low, and they wanted this to be a pullback to the moving average and a test of this high. They wanted the bull trend to continue, and instead we went outside down. We had a big bar closing on its low, and then we had a second consecutive big bar closing on its low. The math is very good for shorting below these consecutive bear bars. It's a bear surprise. However, the risk is big. The stop is further away. You're later in the trend, and the reward is less, but the probability is higher shorting that than it is this. Reasonable to sell below the low of the bear bar in the II. If it was a bull bar, a lot of traders would wait for a bear bar here or here or here and then short, because if it's a bull bar, the probability is less that you're going to get a swing down. And then we have a very climactic sell-off, and then an inside bar. And the bar after it is an inside bar. So now we have an II pattern. If this second inside bar was closing on its low, many traders would wait to sell above a bull bar. Maybe this bar, maybe above that bar. But this is a reversal bar. It went down, it was up. It has a small bear body, but it's still a reversal bar. Some traders will sell above the high of that bar, which is the normal location for entering on an II. You sell 1 tick above the second inside bar. You buy 1 tick above the high of the inside bar, or you sell on a stop 1 tick below. However, this is a sell climax. We have a big bull bar here. We have a micro double bottom, down and up. down and up, I think fewer traders will sell below the low of that bar. If the next bar is a bear bar closing on its low, they might sell below that because then the probability would be better. Here we have a sell climax. You look to the left, maybe a double bottom with the earlier low of the day, a micro double bottom, and then it's a micro triple bottom, down and up, down and up, down and up. It's reasonable to buy above the high of that inside bar or above the higher of the two bars, with this bar being a bull bar closing in its upper third, or wait for a second or third bull bar and then buy. I talked a moment ago about how the patterns in general are small. This is a relatively big pattern. Here it's a relatively small pattern. The distance from the bottom of the pattern to the top of the pattern is small, so if you're shorting below, your stop is not very big, and the reward is very big relative to that small risk. So very good risk reward, and the probability is often 50 to 60%. Excellent traders' equations, so these are very good setups. We had a very strong bull breakout here. You can call it a spike up, and then a trading range, and then we're in a channel, 3 legs up, 1, 2, 3. And then look at this. We have a pair of inside bars. Remember, I said that if you have one of these small patterns late in a bull trend, 20, 30 bars into a bull trend, it often means the trend is going to end soon. And it could end by leading to a reversal down. It can end by going up and failing within 1, 2, 3, or 4 bars and reversing down. In this case, what it did was it broke above the top. I said before, in general, if you're looking to buy with a stop, it's better to buy above a bull bar closing on its high. This is a bear bar, and therefore, in general, it's probably not worth taking that buy. Also, if you think about it, some bulls bought this close. They were disappointed by this bear bar, disappointed by this bear bar. There might be a lot of bulls trying to get out of longs right around that close where they bought. That increases the chances that if we go up to that close or near that close, we'll get a reversal, and we have a little reversal there. This is an II. Theoretically, it's a buy. I would wait to see if this bar, the entry bar, closed on its high, and then buy above the high of the entry bar. It's still a breakout mode pattern, and traders will sell below the low. So some traders will buy above the top, reverse to short below the lower of the two bars, or below a bear bar closing near its low here or here. I would go short below the low of this bar. Spike pullback channel. A spike in channel bull trend 75% of the time has a bear breakout, a break below the bull trend line, and a test down, and then either a trading range or a conversion into a bear trend. If it's a trading range, it then can resume up. In this case, we broke above the top and we reversed down. It was the final bull flag, so this is a final bull flag top. It's also a micro double top. It's a micro triple top. We went up, we went down, we went up, we went down, we went up again. I would call it a micro double top with this high and that high. I think this tail is caused by the bulls who bought here being disappointed by these bear bars and getting out around break even, and bears expecting the bulls to give up, and the bears placed limit orders to sell above that bear bar or around that close. And these two consecutive bear bars closing near their lows represent the final bulls giving up. A pair of consecutive inside bars, 10, 20, 30 bars into a bull trend, a possible final bull flag, especially since it's also a possible wedge. 1, pause, 2, pause, 3. Very often the third leg up will fail and reverse down. It's reasonable to buy above this II. The second bar is a bull bar closing near its high. This is a small pullback bull trend. It could go up much further before you finally have a reversal. If a person did buy on a stop above the high of that bar, he would get out below of this bear reversal bar. And a person who's flat would look to short below that bear bar, even though it has not fallen below the II. Some traders will wait for consecutive bear bars like that because this bear bar does not have a very big body. But given that it's a wedge, II late in the bull trend, a possible final bull flag, I would short below that bear bar or below that or below that, but I would not hesitate shorting below that. Some traders will short on the breakout below the II, which is below that bar. That's about the same price as shorting below that bar. And here we got a couple legs down, not a big swing. Reasonable to sell below the reversal bar, below a bear bar closing near its low, below another bear bar closing near its low. If you take that short, your stop is up here. You're looking for two legs down from a buy climax. So one, pullback, and two. Some bears will give up above this bar, a bull bar closing near its high. Here's the second one. But they could hold short and keep a stop up here. The bears who gave up sold again below that bear bar closing near its low, a wedge lower high, a wedge bear flag, and we got a little bit more down. A very climactic sell-off, and then a pair of inside bars, both bull bodies, and the second one closing on its high. A lot of trading range trading, a lot of trading range breakouts fail and reverse. This is a micro double bottom, and went down and went up, and went down here and up again. So it's a second reversal up. On a smaller time frame chart, an II is usually a triangle. So on this time frame, there's at least a micro double bottom and a pair of very good bull bars. So it's reasonable to buy above the high of that bar. In fact, you could buy above the high of any of these bars closing on their highs. That bar, this bar, that bar, this bar, that bar, maybe that bar. This is a trading range open, and we have a bear breakout. Tail here, tail here. So traders are buying, they're buying, they're buying, they're buying. And the bear breakout appears to be failing, so it's a credible opening reversal up from a sell climax. This low is probably a test of some support, maybe yesterday's low. II, both with decent-sized bull bodies, the second one closing on its high. That makes this a higher probability reversal. Remember I said IIs are often 50 to 60%. This is probably a 60% bet that will get a couple legs up. It could be one pullback two, or it could be a complex one pullback two. When you get these reversals from sell-offs on the open, the market usually tries to get all the way up to the top of the sell climax, which it did. Bulls will buy above bull bars closing on or near their highs. We have something of a wedge top, 1, 2, 3, or 1, 2, 3, 4, or a failed breakout above a wedge, a test of the top of the trading range. Decent bear bar. This is actually an IOI. This is an inside bar after an outside bar. It's a bull bar, so not a great short. Some traders will sell below the low of this bear bar. Some traders will wait for a second bear bar, maybe sell below that. This is a very tight bull channel. Therefore, most traders are not eager to sell. They'll want it to go sideways first, and then they'll look to sell. So they might be selling below that. Here we have a bear surprise, terrible follow through. Not an easy sell below that. A lot of risk and lower probability after the two bull bars. But the main thing is II here, credible buy for a swing up, and then a parabolic wedge top at the top of a trading range. And we have an IOI at a minimum, get out of longs and possibly short. A sell climax on the open. And we have an inside bar after an outside bar. So this is an IOI. So we have an outside bar. That means the bar before is inside. So we have an inside, outside, inside, IOI. And it's also an II. If you want, you can call it an IOII. You can call it just an IOI. You can call it an II. It doesn't matter what you call it. Remember, these are all potential reversal patterns. Therefore, it doesn't matter what name you give. You just look for price action. You're looking at this as the second attempt to reverse up. We tried to reverse up here, didn't get very far. We're reversing up a second time here. That makes it a higher probability buy, but we don't have very good looking buy signal bars. It's reasonable to buy above this bull bar closing just above the midpoint. Higher probability to buy above that bar. Consecutive bull bars, one with a bigger body closing on its high. And this close is right around that high, maybe a little bit above. And bulls will start buying above bull bars closing on their highs. You might buy above that bar, Here, bull bar closing near its high, another bull bar closing near its high, bull bar closing near its high. Consecutive big bull bars, a bull surprise. We'll probably get at least a second leg up. Here, we got a third leg up. Three consecutive inside bars. Now, the lows are identical on all three bars. The highs are identical on all three bars. It's an II here, now it's an III, but this second bar has a low at or below the low of the prior bar. It has a high at or above the high of the prior bar, and therefore it's an outside bar. Therefore, in addition to this being III, it's also IOI. And remember, this is an outside bar, but this also qualifies as an outside bar because its low is at or below the low of the prior bar. Its high is at or above the high of the prior bar. So it's an inside, outside, inside. It's inside, 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 and it's inside, outside, outside. So outside, outside, OO. So it's all three. And again, it doesn't matter what you call it. We have a sell-off, a trading range, and a bull bar closing near its high. So traders will start to buy above bull bars closing near their highs, hoping for a reversal up. And you can keep buying all the way up. A bear trend, and we have a pair of inside bars, consecutive outside bars. But these two bars have small bodies, they're dojis, and they're following just a couple bars after two more dojis. So we're starting to get dojis. When you get dojis late in a trend, it's often a sign that the trend will soon transition into a trading range. We had many of them here, so this could be a possible final flag. So if we sell off, we might reverse back up to this area, or we could just reverse up for the remainder of the day. And now we have an II. But remember when I talked in the definitions about if you have a tight trading range, in general, II patterns are less reliable. Here we have 4 of 5 bars being small doji bars. That's a limit order market. There might be more sellers above, more buyers below. Not good for a person looking for a trend. A stop order market. You can see it triggered the buy. It went above the second of the 2 inside bars. But then it triggered the sell and went below the low of the II. And then it went back above the top of the II. Why? Because it's a limit order market. When you have these small sideways bars, there usually are more people willing to buy below than there are traders looking to sell with stops below. There usually are more people willing to sell with limit orders above than people willing to buy with stops above. So it's an II pattern, but I would not trade it. IIs in tight trading ranges, they're limit order patterns, not stop order patterns, so I would not take that trade. So first reversal up, second reversal up. But at this point, we have 4 consecutive dojis, 6 of the past 7 bars dojis. It's a limit order market, not good for stop order trades. And then we got a bear bar closing near its low. After a couple attempts to bottom and reverse up, you will start to get bears selling below that, especially because we're in a small pullback bear trend. Some will wait for a second bear bar and sell below that. 5 consecutive bear bars, extreme selling, climactic, coming late in the bear trend. It's often a climactic end of the trend. Also, these dojis and these dojis represent neutrality. The market thought this was a fair price and this was a fair price. And now we're getting a climactic breakout below it. So back to those areas where the price is fair. We have an outside up bar. It's reasonable to buy above that. I cannot tell if this high is below that high, at or below. It might be. If the high of this bar is at or below the high of that bar, then this is an IOI, outside bar, inside bar. So inside, outside, inside. You buy above the inside bar, not a very good bar. It's better to buy above a good bull bar closing near its high. So you could buy above that or above any of these bull bars closing near their highs, hoping for a reversal up. A strong sell-off on the open and a pair of inside bars. Theoretically, it's a possible low of the day, and traders could buy above the high of that bear bar, micro double bottom, down, up, As I said, an II is usually a triangle on a smaller time frame chart, but I don't like to buy above a bear bar, especially in a strong bear trend. I would rather wait to see if this is a bull bar closing on its high and buy above it. And for the bears, what they have is a failed bottom attempt and a bear bar closing below its midpoint, another bear bar closing at its midpoint. So bears might short below that bear bar or below the II. I don't like to sell with stops below a cluster of bars with big tails below. Those tails below mean that the market went down and went up. It went down and went up, down and went up, down and went up. So that means bulls are buying when it's low, and I don't want to be selling. Also, remember what I said, an II in a bear trend often leads to a reversal, and if it does not lead to a reversal and instead leads to a resumption of the bear trend, the II very often is the final bear flag. The breakout below reverses, and then you get a swing up, at least a couple legs up. One pullback, two. Here we got several legs up. That's another reason to not sell below all of these dojis. It's probably better to wait to buy a reversal up. You could buy above this bull bar, or you could wait for two bull bars, especially a bull bar closing at or near its high, and buy above that, above that, above that, above that. Here, a little doji after two bear bars and two legs up. You'll get fewer traders buying above that. Some will buy above that, and more will buy above that. And you can see here, it's a high two and a higher low. So low, higher low, higher low. A higher low double bottom, major trend reversal, and a high two, high one, high two. And you can see when it went above this bar, traders were very eager to buy. The close of this bar and the open of that bar, there's a gap. So as soon as this bar closed with a small bull body, traders just bought at the market, and the next bar opened above the close of that bar, and it never traded down. So panic short covering. Final bear flag. We got a bear breakout and went on for a few bars and a reversal up. Look at this. 3 inside bars, 3 inside bars, 3 inside bars. They're all small trading ranges, and they're all breakout mode patterns. It's credible to sell below this. We have a bear surprise bar. We should get a second leg sideways to down. It's possible that this is all we get, especially when we have a pretty good reversal bar here. So if I short below that, I'm going to get out of shorts above a bull bar closing near its high. And then we have another III. So a very intensely sideways market. That reduces the chances that a breakout will be successful. I would not be selling below this bull bar. We're in a limit order market, sideways for 3 bars here, 3 more bars here. Actually, this is sideways for about 7 bars. A limit order market, sideways for a lot of bars with small bodies and prominent tails. Usually more traders willing to sell below and buy above. I would not take that short. And here we got a bear breakout and then an immediate reversal up, a 2-bar reversal. 1, 2, and a bull bar closing near its high. I would buy above that, and I definitely would buy above this. A reversal up with consecutive good-sized bull bodies closing near their highs. You're probably going to get at least a small second leg up. We'll probably get some kind of a swing up. 4 dojis and a bull body. I don't want to sell below that. And here we have III, a bear bar closing near its low, but you're right above support, the moving average. And this is about a 10-bar tight trading range, small bodies, all overlapping one another, very prominent tails. Limit order market, more traders buying below bars than selling below with stops. More traders selling above bars than buying with stops above bars. So yes, it's an II, in this case III, breakout mode pattern, but I think you're better off not trading it. Here we have a small OO pattern. We have an outside bar and another outside bar. But again, a tight trading range, you don't want to be looking for a trend when the market's in a tight trading range, and therefore a breakout mode pattern is meaningless. A bear trend, and we have an II fairly late in a bear trend. It's a bear bar closing near its low, reasonable to sell below, and then, a doji bar. So we went down, we went up, we went down, we went up, and now we went up and we went down. And now we have 4 sideways bars and a doji bar. Once you start to get more bars in a tight trading range and you start to get doji bars, small bodies, big tails, it reduces the chances that you're going to get much of a move out of the breakout mode pattern. Also, if the pattern is coming at the end of the day, the final 5 or 10 bars of the day, there's not much time left for a big move, so the reward is small, and the probability is low because every one of these bars is a reversal, down and up, and then up and down and up and down. The market's probably not going to go very far. So if you're getting doji bars, sideways bars late in the day, and it's a breakout mode pattern, it's usually not worth taking. It's low probability, not much time left, so not a lot of time for a big reward. And these bars are relatively big, so the risk is big. So if you have bad risk reward and low probability for a stop order trader, then it's probably good risk reward and good probability for a limit order trader. So it might make more sense to buy below the bars and sell above. But this late in the day, trading with limit orders is a dangerous thing to do. For me, I would let it go. I might take that short, but if I saw it starting to reverse back up, I would just buy back my shorts and call it quits. I might take this, a second reversal up, a bull bar closing near its high, but you can see it went up, and if it started to come down, I would just get out, break even, or get out before it got down to my entry price. Doji bars at the end of the day lowers the probability that the market's going to go very far. Every doji bar is a reversal, and if the market is reversing, especially reversing repeatedly, it's probably not going to break into a trend at the end of the day. We're in a bear trend, but possibly a third reversal attempt. We would try to go up, try to go up. This could be another attempt to go up, but it's 2 doji bars, small bodies, prominent tails, usually not very good for stop order traders. We have a bull bar here and a bull bar there. Some traders will buy above the II, taking a chance that it's a wedge and we'll get a reversal day. Others will wait to see what the entry bar looks like and buy above the high of the entry bar, so they buy above that and get filled here. But if you get a reversal down here, a bear bar closing on its low, near its low, I would get out of longs. Would I short? After the 2 bull bars, I probably would wait for a second sell. Here we got a micro double top, up, and then down, up, and then down again. So I would sell below the low of that bar and get filled over here, or below that bar and get filled below its low. Tight bear channel, terrible for stop order bulls. When the market's in a tight bear channel, you don't want to be buying with stops above bars because it's a small pullback bear trend. That means pullbacks will be small. There'll be a bar or 2 and not go very far. More likely sellers above bars than buyers above bars. You don't want to be buying above bars. This is what I talked about, micro double top, up, down, and then up here, and then a bear bar closing near its low. And it's at the moving average in a bear trend. We're rallying here, and we have this high might be at or below that high, so II here. We have consecutive inside bars here. We have a bull breakout reversing down a second time with a bear bar closing near its low. So some traders will sell below the low of that bar. This is a tight trading range. Not all dojis, but a lot of small bodies. It's really not very good trading. But you could argue a wedge top. We have 3 highs, 1 from yesterday. Here's the start of today, these dots. So 1 high, 2 highs, 3 highs, and then a triangle. You can call it a triangle. You can call it a tight trading range. This II could be a final bull flag, breakout, and reversal down. Not great math. I would not buy above the II. It's a tight trading range with a bear bar, so I don't want to buy above it. Plus, it's a third leg up, 1, 2, and 3. So we might be at the top of a wedge, creating a high of the day. But here we're getting a bear bar closing on or near its low. I would consider selling below that bar. But a tight trading range that lasts a lot of bars like this, it's not a very good stop order market. The probability is not very good. Remember I said for IIs, OOs, IOIs, the probability is often 50 to 60%. This is probably 50% or less. However, it turned out to be a profitable short. Tight trading range, there's really nothing to reverse. It's not like it's going up. You have a possible top or going down, and you have a possible bottom. It's going sideways. We have a prior trend, but at some point you have to say 5, 6, 7, 8 bars. It's neutral, and there's no trend to reverse. As I said, I would consider selling below that, but I would not be an enthusiastic seller. Now I want to move on and talk about IOIs, an outside bar followed by an inside bar. It's the same idea as IIs and OOs. You're looking for a breakout, and if it comes late in a trend, it's often a final flag, or it can be a reversal pattern. We have a bull inside bar closing near its high. The bar before it is an outside bar. It's outside of that, so it's an IOI breakout mode pattern. It's in a bull trend. It's a small pullback bull trend. Small pullback, small pullback, small pullback. It's a bull bar closing near its high. The bar after is a bull bar closing on its high. So I would buy above the high of that bar, hoping for a swing up. This is another example of an IOI where the bar after the inside bar is also an inside bar. So it's both an IOI and an II. This bar is inside of that. This is inside of the bear bar. You can call it an IOII. It doesn't matter. It's still a breakout mode pattern. And it's a pretty good bull bar here and a pretty strong bull trend. So I'm looking to buy. I want to buy above the high of that bar, above the high of that bar. And then here, we have an inside bar after an outside bar. So another IOI. Late in a bull trend. You could buy above the high of that bull bar, but I'm concerned that we're starting to get a lot of dojis, and that often leads to a trading range. Also, look at the distance to the moving average here compared to here. Trends tend to get weaker as they mature, and therefore you'd expect it to get closer to the moving average before it resumes up. That further lowers the probability for the bulls buying above that. I would wait and not buy above the high of that bar. I'd wait to see if the entry bar is a bull bar closing on its high, and then buy above. For example, here's another IOI. This one's at the moving average, so I would buy that, but you could also buy above the second bar, the entry bar closing on or near its high. Another IOI. This one's at the moving average, and now we also have a wedge bull flag, 3 legs down, 1 bounce, 2 bounce, and then 3, and then we have a good buy signal bar. There's also a small double bottom bull flag, that low and here, and it's a test of this breakout point. There are several things going for the bulls here. That's a credible buy. If you want higher probability, you can wait for a second bull bar. And we got it, so that's even higher probability. Now, is this going to be a final bull flag? I don't know. It's still a pretty small pullback bull trend. Even though we were sideways for 10 bars, the actual size of the pullback is small. I'm not really looking for a major reversal. So is it a final flag? I'm only looking to buy at this point until we start to see bears making money. This is a small pullback bull trend. Inside bar after an outside bar, but doji, the market's losing momentum. We have a breakout above a wedge, and we have shrinking bull bodies. Here, smaller, smaller, smaller. We're losing momentum. The bulls have a high 2, high 1, high 2. You can simply call it a high 1. You could say this is the high and that's a pullback. But with a doji, 2 small bars, I'm not too eager to buy. I want to buy more of a pullback. It's reasonable to take that buy, but remember, these small patterns can reverse. Just like it's a buy above that inside bar. If it reverses, traders will sell below the low of the pattern, which is that bear outside bar, or they'll look for a bar with a bigger bear body closing near its low. This is a second outside bar, and they'll sell below that. Or they'll wait for 2 bear bars and sell below that and get filled over here. So a buy, but not a very good buy. A better sell. Then we start to get bear bars over here. sell below that, sell below that. I don't have it shown in, but we have an outside down bar here closing on its low, closing near the low of that. That's a reasonably good sell. Look at the size of the reward if you held for a swing. If you sell below this bear bar, your stop is above the high of that bar or the high of the pattern, so very little risk. And even if the probability of a swing is only 50%, the reward is 10 times greater than the risk. And therefore, the trader's equation is excellent, even though the probability is only about 50% that you'll get a swing down. Very strong bull breakout, possible measuring gap. This could be a breakout test of that, and it could lead to a swing up. We have a bear outside bar, and then the next bar is a bull bar, and it's closing above its midpoint, but it has a fairly prominent tail. And we have a bear bar here, sideways now for 5 bars. It's a buy, but that tail is not good. It lowers the probability. And whenever the buy signal bar is unusually big, that is another sign that the market might be more forming a trading range than resuming a bull trend. Yes, it's a buy, but the entry bar has a tail and the follow-through bar has a bear body. So what are the bulls going to do? A lot of them will get out around break even, and that's what took place here. A lot of the bulls gave up. They were disappointed by a bad buy signal bar, tail, and a big bar, 2 bear bars here, and then the entry bar, tail, and the follow-through bar, a bear bar. So a lot of the bulls gave up. We got one more push up. You could buy this. We have an attempt by the bears to reverse down, but a 5 bar tight trading range, all the bars with tails, 6 bars. I don't think it's very good stop order buying. And this tight trading range became a final bull flag. We had a very strong breakout, but very often trends end with climaxes, and this is a buy climax. It's also 3 legs up, 1, pause, 2, pause, 3. Remember I said any of these patterns, IOI like that, this is almost an II. We may be forming some kind of a final bull flag, final leg up, and then getting a reversal. Here we have an IOI and a small pullback bull trend, just 1 bar pullback, a 1 bar pullback. Probably not going to lead to a major reversal down. Theoretically, it's a sell below, but 3 dojis and a small pullback bull trend, I'm not going to sell below the low of that bar. And then you can say, well, if it goes below and then above that bar, you have a failed II top, and therefore it's an II bull flag, but it's also 3 doji bars fairly late in a bull trend. I'm not particularly eager to sell below or buy above. You could buy above the entry bar, but has a fairly conspicuous tail below. It looks like we're forming a tight trading range, so I would not sell below that. I would not buy above the IOI, and I would not be eager to buy above the entry bar. In fact, the next bar is another IOI. This bar is inside of that bar, so it looks like we're forming a tight trading range. These are not good setups. Now we have an OO pattern. We have an outside bar and a bigger outside bar. I might sell below that, but if you did, you're disappointed that the entry bar is not very big, and the follow-through bar has a bull body turning up from the moving average. That's not good. So a lot of the bears would give up above this. Bulls might buy, but you still have the problem of the tight trading range. And then what took place on this bar? The bears who sold below that bar, who did not get out, were disappointed by the 2 bull bars turning up from the moving average, and they get out with a limit order around that close or around the low of that bar, and that caused that tail. IOI, and then a second IOI, but tight trading range. Breakout mode, but breakout mode in a tight trading range, it's usually better not to enter with stops. It's more of a limit order market, so better to do nothing. Again, now we have an OO, but a tight trading range. And now I want to talk a little bit about some OO patterns. I have several in this chart. This series of dashes represents the start of a new day. We're early in a bull trend here, and we have an outside down bar followed by a bigger outside up bar. And this is one of those perfect patterns where we have a bull bar here, so some bulls bought above it. And then we have a bear bar outside down closing on its low, some bears short below it. And now we have an even bigger bull outside bar closing on its high. That's a relatively high probability buy above that bar. The entry bar and follow through, not good. But if you take that buy, your stop is down here. Some bulls would get out below that bear bar, but this did not go below that bear bar. And that's good for the bulls. The bears were trying to trap the bulls into a bad long. They were unable to go below that bear bar and force bulls out. Instead, we got that, and traders start to buy aggressively. And then up here, we have a lot of tails, a lot of overlap, and we have an outside up bar and then an outside down bar. But this bear bar never went above that. It's not a perfect pattern. It's a biclimax, a failed breakout of that high, a spike up, and channel. So it's probably a spike and channel pattern. You might get a couple legs down. And we did. One pullback, two at the end of the day. The math is not great. If you're in a small pullback bull trend, you don't want to be selling far below the high because the pullbacks have been small. And now you're selling far down and it might be the end of the pullback. So yes, it's a possible top, but that is not a great looking trade. You got a couple legs down. If you did not get out above this, you ended up losing money on the trade. Here, the bulls are hoping it's a double bottom, a higher low double bottom. This is the start of the day. A lot of trading range trading. A couple consecutive bull bars closing near their highs. Probably always in long. We have 3 bear bars, but we did not go below this low. It's still always in long, but it's breakout mode. I would not buy the first reversal up after the 3 bear bars in our trading range, but a second reversal up with a big bull bar closing on its high, a possible double bottom, higher low major trend reversal. Here's the bottom of the trend, and we got a rally. And this low is above that low, so it's a double bottom, higher low compared to that, and a good bull bar. If that's a credible buy, some will wait for a second bull bar and buy that. If they don't want to risk that much, some will buy a 50% pullback, which is this, or they'll buy a resumption up after a 50% pullback. They'll buy above that or above that. An OO pattern is an expanding triangle on a smaller time frame chart. So we're getting bigger bars, and that's the exact opposite of an II, where you're getting smaller bars, and that represents a contracting triangle on a smaller time frame chart. And a triangle, whether it's contracting or expanding, is a breakout mode pattern. So an OO or an II, both are breakout mode patterns. I talked about this. It's probably an expanding triangle on a smaller time frame chart. At a minimum, it's a micro or double top. We went up here, we were down at the low of this bar, up at the high of that bar, and then reversal down a second time. And this low is the neckline of the micro double top. Up, down, up, and then we broke below the neckline. I would not sell below that. If you're selling, you'd sell below a bear bar closing near its low. Every consecutive outside pattern is going to be a micro double top or a micro double bottom. I talked about that in the first video, the video on definitions. In fact, usually the OO patterns are triangles, expanding triangles on a smaller time frame chart. Here, sideways from here on, here's today's open. It's a continuation of this trading range. Not great for stop entry trading, but we're getting bull bars closing near their highs here and here, decent sized bear bars. Those are trend types of bars, and therefore there's an increased chance that we could get a breakout into a trend. We have an outside bar and then an inside bar. For the bulls, this is a pullback in a bull trend, so it's a high one buy. It's a bear bar, not good. Some traders would buy above this bar. It's the same high as that bar, but they'd buy above that, hoping for a high one bull flag and a rally. And they got a good outside up bar. So it's a credible buy above that. It's a credible buy above this. At this point, it's an OO. This bar is outside of that. This bar is outside of that. But it's late in a bull trend. I don't have the bars over here, but let's say it was late in the bull trend. You have to be thinking that we could get a top. It's reasonable to buy above that. I would not sell below that. I would not sell below that. It's reasonable to take this buy. I would rather wait to see what the entry bar looks like. This is a better buy, but because of the possibility of a bull trap, I personally would usually wait for one more bull bar to see if we got one more bull bar to reduce the chances that it could be a bull trap, which it turned out to be. It's reasonable to take that buy, but if you buy it, you have to get out below that. Most traders don't like to reverse, but that's an obvious reverse. If I bought above that, I'm going to sell below that, and I'll probably more than make up the loss. So if I buy above that and I sell below this, I lost from here to here, and I'm expecting to make at least that much back, if not more. If I did not take this buy or that buy, and then I see this, 3 consecutive outside bars, all with big bodies, I am going to short below that, or I'll wait for a second bear bar and sell the close. And look what happened as soon as this bear bar closed. We sold off, very little bounce. So a lot of traders waited to see if we'd get a second consecutive bear bar after the outside down bar, and then they sold the market, and we got that. The bears who did sell below this, they would either get out above the bear bar or above the bull bar, and they ended up being trapped into a bad short. And the bulls who bought above the 00 got trapped into a bad long. Three consecutive outside bars, outside, outside, so it's an 00 here, and now it's an 000. And you've had clear trap bulls here and here, trap bears below that bear bar. Chances are the next breakout we get is going to be the start of a swing. So I am looking to sell, especially when I get a big bear bar closing near its low. This is a relatively high probability of a swing down. This is probably a 60% chance for a swing down. This is one of those ideal or perfect 00 patterns. It ended up as an 000, but you clearly had both trap bulls and trap bears, and that increases the chances that a breakout will be successful. Some bears sold below the low of that bull bar. Others waited for a bear bar closing near its low, and they sold below that. We have an outside bar and a second outside bar. So it's an 00 pattern, but these 3 bars are dojis, and so are these 2. So you have 5 consecutive doji bars. That's a limit order market. Every tail below a bar means that when the market went down, it immediately reversed up. When it went up, it immediately reversed down. So it's a limit order market. It's reversing. That is a bad market for traders looking to enter with stops. So I would not buy above that bull bar. I would not sell below the low of that bull bar. 5 doji bars. I want to wait for the market to start trending before I take any stop order trades. A big outside down bar, bottom of the range. Some traders will start selling here, especially because the bulls have bought here or here are now trapped. Others will wait for a second entry. And even the second entry is not good. All these bars have prominent tails. In fact, the past 15 bars, past 20, 30 bars all have prominent tails. Usually you're not going to get a strong trend. We got a pretty good swing down, but when I see a trend like that where all the bars have big tails and small bodies, and there is a lack of consecutive big bear bars closing on their lows, the trend usually will not last all day. It usually ends up as a bear leg in a trading range, and you can see going into the close, we undid all of that selling. So this is not good stop order trading. At the low, we have an outside bar and then an outside down bar, but it's late in a bear trend. And remember, any of these patterns, II, IOI, OO, if they occur late in a trend, there's an increased chance of them leading to a reversal or of a breakout in the direction of the trend, in this case down, and the breakout failing and then the market reversing, so the pattern becomes a final bear flag. So I am not eager to sell below that bear bar closing near its low. Here we're sideways for 7 bars, 6 bars, and all the way down, big tails below. So I'm looking for a reversal. I'm not going to sell below that bar. It's late in the day, so it's not really great to buy above the 00 either. You want to buy up here. We have a very big outside bull bar closing on its high, but you're in a limit order market, lots of reversals. Do you really want to risk that much this late in the day? So I would not do anything with this. I would not sell below. I would not buy above, and I would not buy above that. I would wait for tomorrow. This is a 15-minute Globex chart, and we have 3 consecutive outside bars and a very good bear bar closing near its low, so it's a credible sell below. And then what do you do with this? Well, it's a big enough bull bar reversing up from the moving average. I would get out of shorts. This is such a big bear bar, I probably would wait to see if we had a good entry bar for the bulls who bought above that. We did not. And now we have a second buy. I would take this. This is a second reversal up from the moving average. And after 2 attempts to go down, 1 and 2, and a bull bar closing near its high, bull bar closing near its high, I would take this buy. But when you get sideways trading late in a bull trend, there's an increased chance it'll be the final bull flag. So if we do get a bull breakout, you got to be thinking it might reverse down. If I take the buy above this bar and I see a bear bar closing on or near its low, I'm going to get out of longs because a lot of traders will view this as a possible final flag, a tight trading range late in a bull trend and a buy climax and a decent bear bar. Traders will short below that bar, hoping for a swing down. 2 legs down to the moving average, 1 bounce, 2, and a second strong reversal up with a good bull bar. It's a credible buy. We have a failed breakout above the 00. We broke below, that failed. We're breaking above, that's failing. Reasonable to short below the low of that bear bar, and you get filled right there. We have an outside up bar, but after 3 big bear bars in a bear trend, I don't want to buy above that bear bar. It did not go above the bull bar. And we have outside down, so outside up bull bar, outside down bear bar, but look to the left. We might be forming a double bottom. It might be near the bottom of our trading range. 3 legs down, 1 pullback, 2 pullback, 3, and a micro double bottom, down, bounce, down. So I'm not eager to sell below the low of that bar. Remember, when you have any of these patterns late in a trend, there's an increased chance of a reversal. With this being near the low of the day, there's a possible double bottom or higher low. I would wait to see what the entry bar below that bear bar looks like, and if it's a second consecutive bear bar, then maybe short below that. But I think there's too much risk of this reversing. A wedge to a higher low double bottom. Possible final flag. So we break below it by a tick or so and reverse. This 00 then is a small final flag. There's a small breakout and a reversal. Some traders will buy above that big tail. Others will wait for it to go above the 00 and buy above that. Others will wait for a bull bar closing near its high and buy above that. Failed 00 breakout. You can call it a small final bear flag. On the open, we have a lower low double bottom and then a pullback to a higher low. If you want, you can call it a triangle open. You can call this a double bottom pullback. So a double bottom and then a reversal up and a pullback to a higher low. I'm looking to buy. I would buy above a big bull bar closing on its high, especially breaking above the trend line. Or you could wait for a second bull bar closing on its high. In this particular case, the second buy was an 00. We have an outside down bar here, an outside up bar here. It never went below the bear bar. Instead, we went above and we have a bull bar closing near its high. This is a gap up open. Here's the moving average. I'm looking to buy. We have 2 bull bars here, a double bottom, reversal up here, a reversal down, did not go below the stop. The bulls who bought above that or above that have a stop here. And this is a double bottom pullback. That's a buy. I'm looking to buy. I'd buy above that. I would not be stopped out, did not go below a strong bear bar. And if I did not buy, I would buy above that or that, looking for a swing up. This is a bull flag early in a bull trend. The bull trend began here. This is the daily chart. We have a very big bull bar, and it's an outside bar. And the bar before, the day before, was a bear outside bar. So we have a bear outside bar and a very big bull outside bar. This big rally is this big bull bar. And for the bulls, we have a bull trend and a pullback. You can call it a small double bottom, a micro double bottom. You could also call it a wedge. We went down here, we went up, down here, up, and then down here, up. Big risk. You're buying above a very big bar, so the stop is far below. Pretty much sideways, so the probability is not all that good, but it is a credible buy. Some traders will wait for a second bar and then buy. Very strong rally on the open. Here's the moving average, so it's a gap up. We tried to reverse down here, and we tried to reverse down a second time here, but did not go below the low of that bar. Instead, we got a bull bar, a second inside bar. So we have an inside bar and a second inside bar. Theoretically, it's a buy above the high of that bar with a stop below the low of that bar. Some bears would go short below the low of that bar. I'd wait for a couple consecutive bear bars. This is such a surprisingly big bull bar. Chances are we're going to go higher. So the bears have a low 2. We went below this bear bar. That's a low 1, a first reversal down. We went below the low of this bull bar, and that's a second reversal down. But I'm not willing to take that short. Now we have an II, consecutive inside bars, and then we have a bear outside bar, and now we have a bull outside bar. I think the market's always in long. This is a big enough bull surprise so that we should get at least a small second leg up. It's possible that we'll get a bull trend. So I'm not selling below that bull bar, so I'm not going to get short here. And you could take a short below that bear bar, a micro double top, up, down, up. But I think this is so strong, we should get more of a second leg up. If we got a second bear bar closing near its low after that bar, I might sell below that bear bar. But instead, we got outside up. So we have outside, outside. I would buy above this bull bar. Traders will buy above bull bars closing near their highs. Above that, above that, above that. Here, it's a possible wedge, 1, 2, 3. A lot of the bulls, if they bought above that, would get out below that, and then they'd wait for another bull bar closing near its high to buy again, and buy maybe above that. A bear trend, and we have outside down, and now outside up. 3 dojis, not good for stop entry traders. A pretty good bull bar, so it's a possible reversal, but with the 3 dojis, I think it lowers the probability. Whenever the probability is not as high as I want, instead of selling below the 00 or buying above the 00, I want to wait to see what the breakout bar looks like. If it's a strong bull breakout bar, then I'll buy above that. If there's a strong bear breakout bar, then I might sell below that. Here we have a couple consecutive bear bars. Theoretically, it's a sell below. I don't like the tail. I don't like the bull body. And I don't like the market being this late in the day. Not much profit potential. And the probability is not all that high with that tail and that bull bar. So this is not really good for stop entry traders. You can argue it's a failed bottom and therefore a bear flag, a low 2 bear flag, low 1, pullback, low 2. Some bears will sell below a bear bar closing on its low, looking for a swing down. So they won't think of this as an 00. They'll simply think of it as a 2-legged pullback to the moving average, a bad sell signal bar here, a bull doji after a big bull bar. But if you're trading always in, the market's clearly always in short. And if you get out above that bull bar, we're still always in short. Bears will look for a bear bar closing near its low, and they'll sell below. So you can take a short below that big bear bar, hoping for a resumption of the bear trend. But I think that the math is not all that strong. We have an outside down bar and outside up bar, but prominent tails. and we're pretty late in the bear trend, and we have a lot of prominent tails here, small bodies, prominent tails here, small bodies. So the market thinks that this price is pretty fair. The market spent, I don't know, almost an hour here, and now we're getting more sideways bars with big tails. This is not a strong sell below that bear bar. You might sell below this bear bar, closing in its bottom third, but too much risk that this is a final bear flag or that this is a final bear flag. So if we do go down, there probably will be profit taking into the close. If I sold below that or below that, I would get out above a bull bar closing near its high. And aggressive bulls might buy, looking for a swing back up to there or here into the close. It's actually 3 consecutive outside bars. This bar is a small outside bar. Here's a second, and here's a third. First, I talked about II, consecutive inside bars examples. I then talked about IOI, an outside bar followed by an inside bar, and that means there's an IOI, an inside bar before the outside bar, and then consecutive outside bars, OO. All of these patterns are breakout mode patterns, and when they occur in trends, traders expect one of two things. First, they look for a reversal. If instead the trend resumes, they think the pattern is an area of agreement, and therefore the resumption of the trend usually does not get very far. So they're either reversal patterns or final flags. So in a bear trend, a breakout below usually does not go down all that far. You get a reversal back up to it. In a bull trend, if you get a bull breakout, yes, it's a breakout mode pattern, it's a bull flag, but usually the breakout's not going to get all that far. I'm Al Brooks. Thank you very much for your attention. I hope that you found this helpful.